Welcome back to our real estate valuation series. In our last videos, we explored both the cost approach and the sales comparison approach. Today, we're diving into the income approach, a favorite among real estate investors. This method focuses on a property's earning potential because, let's face it, cash flow is king in real estate. Instead of looking at what similar properties sold for, we're diving into how much money a property can generate. The income approach is like figuring out the value of a money-making machine. The more money it makes, the more valuable it is. This approach is especially useful for investors looking at properties like apartment buildings, office spaces, and shopping centers, anything that brings in rent. Now let's talk about a crucial piece of the income approach puzzle, the net operating income, or as we call it in the biz, the NOI. This is the bread and butter of income-producing properties, showing you how much cash the property generates after covering operating expenses. To calculate NOI, start with the property's annual gross income. This includes all rental income and any other income streams the property generates. Then, subtract operating expenses, such as property taxes, insurance, maintenance, utilities, and property management fees. Keep in mind that NOI doesn't include things like mortgage payments or capital expenditures, like a new roof. It's all about the day-to-day income and expenses of running the property. The net operating income calculation is just one piece of the puzzle. Another piece of the puzzle is the capitalization rate, or as we call it, the cap rate. Think of the cap rate as the rate of return you can expect on your investment, similar to an interest rate on a savings account. It's calculated by dividing the property's net operating income, NOI, by its market value. A higher cap rate generally suggests a higher potential return, but also potentially higher risk, while a lower cap rate might mean lower risk, but also lower returns. Understanding the cap rate is crucial for comparing different investment opportunities. It helps you answer the question, how much return can I expect on my money, and how quickly? Time to put our knowledge into action with a real-world example. Let's say we're looking at a mixed-use building with a coffee shop on the ground floor and apartments above. The annual rental income is $100,000. After deducting operating expenses of $30,000, the NOI comes out to $70,000. Now, we need to find out the market value of similar properties in the area and their cap rates. Let's assume comparable properties have a cap rate of 7%. To estimate the market value of our mixed-use building, we divide the NOI, $70,000, by the cap rate, 7%, which gives us an estimated market value of $1 million. This example shows how the income approach combined with market analysis can help investors estimate the value of income-producing properties. But here's the thing about cap rates, they're not one-size-fits-all. They can vary significantly depending on several factors, including property type, location, condition, market conditions, and interest rates. For example, a brand new apartment building in a booming city centre will likely have a lower cap rate than a property in need of renovation in a less desirable area. Why? Because investors are willing to accept a lower return for a less risky investment. On the other hand, higher risk properties typically command higher cap rates to compensate investors for the added risk. Understanding these dynamics is crucial for making informed investment decisions. So, how do you determine the right cap rate for your investment property? One word: research. Look for comparable properties in the same area that have recently sold. Analyze their cap rates to get a sense of the market. Don't be afraid to tap into the expertise of real estate agents, appraisers, and other professionals like our company, Al Baida Real Estate Company, who have their fingers on the pulse of the market and can help you stay ahead of the curve. They can provide valuable insights and help you interpret market data to make informed decisions. Remember, determining the right cap rate is both an art and a science. It requires careful analysis, market knowledge, and a good dose of intuition. By combining your research with expert advice, you can increase your chances of making smart investment choices.